We have Netflix hitting another all-time high. It's trading now around $415, or just under $416. It's come off the highs a little. It's following Pivotal Research Group raising the stock's price target to $500 at their shop from $420 per share. Now, the second firm this week to give the company a $500 price target says it expects solid second quarter results and third quarter guidance, and that the recent AT&T Time Warner deal will boost Netflix shares.
Up nearly 6% in roughly the last week. Can Netflix's rally continue? Joining us to discuss is Daniel Ives from GBH Insights, the first analyst to give Netflix a $500 price target earlier in the week, and David Traynor from New Constructs. Very good afternoon to you both. David, I'll start with you because you have a negative view on the stock. Talk us through why you don't think this $500 target is achievable.
Well, it's mainly because the company's spending 120% of their revenue every year. And a lot of the reason you see most of Wall Street cheering this kind of activity and boosting the stock price or target price is because they're going to make a lot of money helping Netflix sell the shares or debt that it needs in order to continue to fuel the cash-burning machine. On top of that, you're looking at a valuation that implies the company's going to grow profits at 25% compounded annually for almost 2 decades. And even if they double prices, that means they have to have 3 billion customers. So we don't see good risk reward here, even if you might see some short-term technical tendencies that do look positive.
All right, Dan, so how do you get to a $500 share price for Netflix?
Yeah, I mean, look, that was the same argument when the stock was 200, right? And look where it is today. And I think part of it, as far as through the tree, is it's all about content at this point. I mean, they continue to be with 125 million subs and growing. We think international, that's the story. I mean, 68 million subs today. We think they get to 100 million by 2020. You do a sum of the parts analysis on Netflix, which is how we got to our $500 price target. Ultimately, this is one where the margin expansion story over the coming years, content which they continue to own, call it $8 billion this year, $10 billion next year. And you look what's happening in the industry. Even if Disney gets 21st Century Fox assets, we don't really see for the next 2-3 years a formidable competitor. And I think at this point, it continues to be Netflix, named. That's the name to own in streaming, and it's their world and everyone else is paying rent.
Daniel, what would make you think that you could get? What are the biggest risks to this? If a revamped Hulu or a revamped Disney streaming service was really powerful, would you be concerned?
Yeah, I think the biggest risk here is really international. Can they duplicate what they've done here domestically, internationally? That's really the growth story here. I mean, in order to get to a $500 stock plus, international needs to take off. You talk about competition. Look, I think that's why everyone's really watching this Disney-Comcast battle, because ultimately, if some of those assets get split up, a Star India, Sky, that ultimately makes Netflix that much stronger, which is what you've seen the street's reaction here. So I think it's more competition. The Disney potentially is a long-term threat. And ultimately, it's really international. If they could be successful internationally, we're looking at a stock that we believe goes, much north of $500.
All right, David, you want to respond to that?
I don't think there's a fundamental argument that makes any sense around Netflix. I mean, I don't know how you get to $5 to $8 billion for valuing content when that content doesn't produce any cash or make any money. Look, it's right. It's the same argument for a long time. At some point,
it does deliver money.
It delivers revenue, but at a negative profit, right? So they're paying more for the content than they can generate in revenue. 120% more overall to run the business than in revenue they make. So free cash flow was something like negative $2 billion last year. We're thinking negative $3 billion this year. They only have $2.6 billion on the balance sheet. They're going to have to raise capital, and they're going to continue to have to raise capital. So we're talking about a business that's going to have to make a drastic swing from negative profitability to positive profitability while also growing a lot. And I don't, in as much as the stock price might have short-term good performance, the risk reward here it's really hard to make sense of in any fundamental way.
All right, so before we go, Dan, explain how Netflix can pull this off and make it so that they're not burning cash and that the new people they bring in aren't causing them negative profit.
Yeah, I mean, look, they continue to be the LeBron James of content here. And I think if you look going forward, they're investing near term, but longer term, that's where the margin story starts to play. You look at ARPU expansion. Look, we've seen about 90% of customers are willing to pay another $2, $3, especially for 4K. So I think you start to see subscription prices go up international. You put that through the model. I mean, you have $15, $20 of earnings power as you look out 5, 6, 7 years.
All right, we got to go. But David, if he says they're the LeBron James, you say they're the who?
I don't really. You tell me.
Putting you on the spot here.
Yeah,
I don't. Proper basketball analogy.
Hey, how about Eddie Murphy? Eddie Murphy? I don't know. I mean, you know.
I don't know. He might have a good jump shot.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.